property market's buzzing again, and this week the numbers confirm it. Unemployment has nudged lower, the Reserve Bank's cut rates, and auction markets around the country are showing signs of, dare I say, boom time energy. But what does all this mean for property buyers, sellers, and investors? In this week's Property Insider, I'm joined as always by Australia's leading housing economist, Dr. Andrew Wilson, to unpack the latest economic and property data. We'll look at why the Reserve Bank eased rates again, what's happening in the jobs market, and how these shifts are flowing directly into strong auction clearance rates across the capital cities. Clearly, lower borrowing costs and rising confidence are adding fuel to what's already a hot market. But is this sustainable? Or are we just setting ourselves up for another round of affordability issues? And I plan to ask Dr. Wilson to share his outlook on whether these rate cuts really just the beginning, or how we're going to go heading into spring, and why some cities are seeing stronger results than others. So if you're trying to make sense of the cross currents, falling rates, strong demand, but lingering affordability concerns, we'll give you some clarity amongst the many mixed messages. Hello, Andrew.
Yeah, hello, Michael. And we're just about out of winter now, aren't we? And
Yes, we are. But we've got springtime auction energy, in fact, springtime market energy, haven't we?
I was just going to say, Michael, that are we not confusing August with September at the moment? But one would think so. It's been a very robust, not just August, but also June and July. So a strong winter market, unquestionably a strong winter market, and will be refueled by lower interest rates.
Well, often just a simple policy move can shift the entire mood of our housing markets, and we'll get on to what the Reserve Bank did last week. But another sign that we keep looking at is, how is our economy going? Obviously, the Reserve Bank looks at that as well, and one way of measuring it is the jobless rate. And I guess a lot of people were wondering what's ahead for our jobless markets, considering that the last couple of months unemployment rate nudged up just a little bit, but the latest figures came in and showed they've dropped again.
Yes, Michael, it was fuel for all the bears out there who were predicting doom and gloom when our unemployment rate increased to 4.3%, which was the highest in a couple of years. And, as I said, it was fuel for those negative headlines out there. But probably predictably, we saw the unemployment rate ease back to 4.2%. Over July. And of course, that is, again, a very low result. In fact, it's the same result as we had in July last year. So we've gone nowhere in a year in terms of...
But if you look at the participation rate, it shows the labour market's absorbing the workers in face of all these challenges.
At record rates. That's the whole point. We miss that, the participation rate, which is sort of the guiding measure for the unemployment rate. Because if we had a lower unemployment rate but a low participation rate, it means that we weren't seeing a higher proportion of those in the potential workforce actually getting jobs. But we have still a near record high participation rate that remains steady at 67.1% over June. And, that just again emphasises just how strong our economy is. And really, the longevity of the strength of Australia's labour market is there for all to see. We've just been floating around those high 3, low 4s for the best part of 3 years. And as I said, it was obviously once the unemployment rate did tick up, and these things can happen, as a reflection of the statistical measures that the ABS undertakes, particularly the seasonal adjustment. But back to 4.2%, and of course the bears have all run away now. And as I said, and as you mentioned, Michael, the participation rate is the key coefficient in terms of describing our labour market as being strong, which it is. And New South Wales, Queensland, and WA all shared the lowest unemployment rate over July at 4.1%. So there's really no bad news there at all in terms of the unemployment.
It's good for the housing market.
Absolutely. And look, as we've discussed over the years, Michael, one thing that really does put pressure on our housing markets, other than obviously higher interest rates, is a higher unemployment rate, and an unemployment rate where we do see it shifting maybe into the 5s or even the 6s, because people then become concerned about making purchases. They become concerned about job security. There's, if anything, downward pressure on wage increases. So that is a fundamental factor in housing market activity. And look, we've just got no sign of that at the moment. I mean, those low threes, middle threes that we had through 2023 and 2024 were historically low unemployment rates, Michael. And we're still at the levels we were during the great mining boom period prior to 2010, between 2000 and 2010. But the big difference here, Michael, again referring to the participation rate, is our participation rate is significantly higher than when we were tracking those high three, low four unemployment rates, 20 odd years ago. So it's, on the stats, it's a very, very strong, almost an historically strong labour market that we have at the moment. And as I said just before, that's a positive as well as interest rate falls. Clearly a positive for the housing market.
If people have got jobs, if they've got incomes, but I think more importantly also confidence, Andrew.
Yeah.
So there's the confidence from I've got a job and if I lose it, I can get another one easily. But also for property investors, strong employment's critical because it means tenants can keep paying rent, supports household spending, and that helps as well. They also got confidence with the Reserve Bank's decision last week, Andrew.
Yeah, it was probably just about a certainty, was it not, Michael? Although
yes,
said in the previous month, but I think that when we, as we've discussed, when we look at the history of the Reserve Bank decision over the past year or so, they have been, and clearly stating they've been tracking the quarterly ABS inflation data. They were waiting for that quarterly data, the June quarter data, before they did make a decision, just to, I guess, confirm what the monthly data had been telling them in terms of matching the midpoint of their target range for inflation, which of course is 2 to 3%. The June quarter did confirm that. In fact, the June monthly data reinforced that, Michael, because it was actually even lower than the quarterly data. So that would have given the Reserve Bank plenty of confidence to move forward. And I think it would have been an absolute shock if they hadn't have cut rates going forward. I think the question is, where do they go from here? And of course, the other factor that probably was the icing on the cake in terms of an interest rate cut decision was the fact that we did have a higher unemployment rate over June. So that was just something they might have thought, well, okay, just in case we are getting a shakeout in the labour market, it can't hurt to have a lower interest rate. But as I said, going forward, I guess the point is, where do we go from here? I'm interested, Michael, that the Reserve Bank hasn't really mentioned much about what is happening in the housing market in terms of its decision making. Now, if we shift back a couple of years or a decade, but a couple of years to the previous Reserve Bank board, they were very much focused on what was happening in the housing market. And I think, and we were critical of that at the time. One of the reasons why the Reserve Bank held rates on hold for a record period through 2017 and into 2018 was because they were concerned about higher house prices. And at the end of the day, in my opinion, that was a mistake because we were struggling in terms of our economic performance. The rest of the world was cutting rates and we were sort of lagging behind that. And I think that there was just too much focus then on what was happening with housing markets and too much worry about the theory of housing bubbles, etc., that kept rates on hold. And of course, at the end, in 2019, the Reserve Bank was forced to slash rates 3 times through the second half of 2019. And it's interesting that we don't have that same sort of energy with this particular Reserve Bank, who are more interested, perhaps, I don't know, in consolidating lower inflation with against worries about higher house prices. But maybe the Reserve Bank realises what we've been saying also for quite some time, that Australia has a lot of natural stabilisers in its housing markets. We have very restrictive finance models, which other similar economies don't have. So we aren't really encouraged or allowed to overborrow in a sense. And it's that overborrowing that creates, I guess, higher house prices beyond affordability scenarios. And the affordability, of course, is whether you've got the income to repay your housing loan. And as I said, I think that's what's that natural stabiliser that keeps our housing markets reasonably secure through the cycles. Not that we don't get overshoot in the short term, and that can happen, at the peak of cycles, but that adjusts itself again because we we do have those stabilisers. But going forward, I think we can't use, I guess, the sense that the Reserve Bank is concerned about housing market price growth in terms of their interest rate decision making. So, I don't think that's going to hold back another interest rate cut if they feel it's warranted. That's interesting. And as I said, I think that's a positive because, as I said, I believe we have the stabilisers there. I think they'll be looking at our labour market. And I think the fact that the labour market continues to perform strongly, that might be the offset for more interest rate falls. But I think they will keep an eye on the inflation rate going forward. And if that continues to be adequate in terms of meeting the target range, I think they will. I think that they will maybe consider rate cuts again. But I'm not sure it'll be the next time. I think they'll.
I'd agree with you. There's next meetings at the end of September, and then there's the Cup Day meeting, and that's traditionally a time when they drop interest rates before the Christmas period when they don't meet for a while, Andrew.
Yes, you're right, Michael. And as I said, I think that, and also the national atmosphere is certainly stabilised. We've moved away from all that ridiculous hysteria we had in April, which was completely overblown in regard to the consequences for the Trump tariff policies, which have been all over the shop since then. And there's really no sign in the US, no real sign in the US that there's been any damage to their economy from, particularly in terms of inflation, from the tariff policies. And those tariff policies remain quite fluid anyway. And I think the potential for, sort of a scary response from consumers is past now. And then perhaps the media will need to focus on something else to cry wolf about.
I just wanted to remind you that this is not specific investment advice because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of the opportunities the current property markets are offering. So why not have an obligation-free chat with one of the wealth strategists at Metropole to discuss your goals, your options, and what you could do? We're much more than just another buyer's agent. We help you safely create intergenerational wealth through strategic property and wealth advice. Remember, property investment's a process, not an event. So you can't just go out and buy any property and hope to be successful. In fact, now more than ever, getting the right advice is critical. So if you're looking to invest in property or buy a home, go to metropole.com.au and organise a time for an obligation-free chat. You're going to find that at Metropole, we're big enough to tip the scales in your favour, but still small enough to care. And since we don't have any properties to sell, our advice is independent and unbiased. Well, the media is also talking about boomtime auction results. If you're wanting proof of how quickly market psychology can shift, just look what happened to the auction markets over the weekend, Andrew.
Yes, it's. I was going to say amusing, but I'm not sure it's amusing. But we had another very good week in terms of auction market activity. As I said, the lower interest rate energy is certainly accelerating the confidence in our property markets. Another week, we could say strengthening of home auction results, and of course that did follow the RBA cut, as you said. That adds to confidence as well as improves affordability. There's momentum now gathering, and I think that one of the key factors is that we'll start to get that fear of missing out energy moving into buyer psychology. When they do start to acknowledge that prices are rising and rising rapidly into spring, which is potentially where the markets will be, that people will start to think, well, I better get into the market now before I have to pay more next week or next month. And I think that's, a very positive environment, particularly for sellers in prospect over the next few months. But yeah, Sydney recorded an 80.1% clearance rate, Michael. We use 80% as a benchmark for that B word, which is boom. Higher in Sydney. This is the second 80% result Sydney's had in the last 6 weeks. So it hasn't sort of come out of nowhere as a statistical aberration, perhaps. And Sydney's now tracking around 10% higher than where it was a year ago. So, yep, another 80% clearance rate in Sydney on higher auction numbers too. So it's, higher auction numbers are being absorbed. Clearly a seller's market in Sydney, plenty of competition for available properties. And as listing numbers rise, we can't really expect not to see the same sort of results given the consistency of the strength of the Sydney market. Melbourne too, mid-70s again in Melbourne, higher auction numbers, again 10% higher than where the Melbourne market was a year ago. Isn't it remarkable, Michael, the turnaround we've seen in Melbourne, which actually we were speculating on at the end
Early
of last
in the year, definitely.
and the beginning of this year, that it was an opportunist market, and that's how it's panned out. And
it's still not too late, Andrew.
No, still upside for that Melbourne market, Michael. It's certainly underperformed in terms of prices growth compared to the other capitals. And yet the Melbourne economy is tracking similarly to other economies. Yes, it has higher levels of debt, but its employment profile is still very positive. And as we mentioned, that's a key in terms of housing market decision-making is the jobs market. So Melbourne, yep, higher auction numbers, another good result, 74.8%, again, 10% higher than the same time last year. Brisbane, as we know, that Brisbane market tracks between 50 and 60 in a positive sense, 51% clearance rate in Brisbane. Adelaide back in town, 75% clearance rate in Adelaide. But the real surprise packet recently has been the Canberra market, Michael.
Yes.
An 80%, which really sort of knocked me off my feet, an 86% clearance rate in Canberra. Okay, we need to have a few more weeks before we can really call a Canberra market booming, but that's a very positive result, and obviously a very positive result, 86%. And maybe the Canberra buyers have finally realised it's time to get back into the market after being in the doldrums for a couple of years, similar to Melbourne. And we have spoken about the re-emergence of Canberra, but Canberra has a few local policies in regard to the housing market, I think, which is sort of retarded it. But yeah, look, another positive week. Two capital cities, Michael, with 80% clearance rates, and the rest all very positive. And we've only just seen the first week of the interest rate cut. So this is really, the first week of the interest rate cut, and this will build momentum, in my opinion, going forward, particularly entering into the spring selling season, which is typically the strongest part of the year. And I think that particularly in Melbourne, we'll start to see prestige property starting to heat up. And that's where the missing link has been. And I think that'll be interesting to see how that pans out over the next couple of months. If you're looking for the latest weekend auction market data, My Housing Markets through my LinkedIn account, Doc Andrew Wilson at LinkedIn, releases the Capital City Snapshot every Saturday night at 6 o'clock, and Michael publishes the full national report on Sundays through his social networks, where you will get not just the headline results, but also the regional results for Sydney and Melbourne, and also the top 10 sales under the hammer for each of the capital cities over the past week. So here we are again, Michael, moving into the last week of winter, and certainly a very positive springboard, again, using that analogy into the spring selling season.
Well, clearly we're going to have a fun spring selling season, so I look forward to chatting with you again next week, Andrew.
Thanks, Michael.